take it away, Albert.
Cool, awesome. Thanks for joining, everybody. Hopefully this will be useful. I think the way I've structured today's session is that if you're already like really, really great at Excel, so if you've come from like a banking or a kind of consulting background, or you're in kind of strategy and ops in a startup at the moment, this session will probably be a bit too basic for you. But otherwise, if you don't come from that background, and even if you do come from that background, hopefully it's still relatively useful. I think what I'm going to walk through today, kind of two main things. The first is kind of outlining generally what I think is best practice when it comes to building an Excel model or a G-Sheets model. And then secondly, kind of walk through a super basic example of an Excel kind of high-level model that walks through kind of revenue, costs, OpEx, EBITDA, and then how you generally kind of forecast that. Any questions? Anything anyone wants me to cover very specifically? No, cool. I think
show us how to build B2B SaaS.
A few. I'm not sure if there's a few people in the waiting room, Jono, because I think I got a notification, but I'll let you shepherd them in. Cool. So I think I just want to quickly just kind of talk through Excel, like just quickly, like who here uses Excel daily, weekly, just to get a sense of like what everyone's doing. And I know, these calls are a bit weird, but it's also just good to get a sense of like, what do you use Excel for at work? Just so I can get a gauge of like who the audience is tonight.
Do you want us to tell you what we...
Yeah, please. Okay,
so I run a dance school. So I use it for recording the days and the times that I hire the studio, because I don't own it, and then I send that record to the owner of the studio. I also use it for budgeting, just keeping track of everything, all the expenses. And I also use it for client details, so keeping a track of all my clients, all their details, their addresses, phone numbers, everything. There's one more thing I use it for, and my personal finances too. So
nice, cool, very, very, that's pretty broad use. Maybe I'll get one more person to share before I move on.
Maybe Sean can share.
I use it for modeling as well, and just wanted to learn some tips from Albert, seeing as he's the GOAT, so I just thought I'd come
in. That's too kind, thank you, I appreciate that. Okay, cool. Yeah, so I just want to get that kind of Excel is a tool, and so like it's really only as good as obviously the person using it, but it can do a lot of crazy things. And so as you kind of walk through Excel and people start to use it, you really get to see a whole range of people using it in crazy ways. I think the benchmark for me is like, if you can make pivot tables, you're probably already in like the top like 10% of Excel users. And that's probably super basic, but a lot of people use it for very basic data entry, use cases, and not for any sort of basic analytics. So if you can use that, that's kind of where you are at in your Excel journey. I just want to throw it out here before we keep moving on. It is better than G-Sheets. I think G-Sheets is kind of terrible. It serves a purpose, but Excel is, definitely up there if you're trying to build models. So why use Excel? I think really when you come into any heavy quantitative careers or jobs, or if you're looking to push Excel to its limits, generally you're trying to do three things. The first is like forecasting. So you're trying to forecast revenue, profitability, growth. You're trying to understand, in the future based on historical performance, how you're going to perform. The second is like estimating. So looking at how big is the market? What are the market segments? How do I understand, or how big is, the size of the pie that I'm trying to go after? So a lot of founders will use this to think about market size. A lot of VCs will use it to estimate truly what the TAM is, or who the customers within the TAM is, and start to narrow down a pie. And lastly, it's around sensitivity testing. So looking at based on, my business, if I increase the price, by 10%, what's that going to do to my top line and then my bottom line? So what's the impact on revenue and profitability? Well, no, here's a super specific example, but what happens if the interest rate on my loan or my debt changes, whether if it goes up or down, and how's that going to impact my business? So really, a lot of people use Excel for different things, but specifically if you're looking to do any sort of financial modeling, you're really doing one of three things, and often all three things at once, which is you're building a forecast, you're estimating the size of something, and then you're testing your assumptions to see how sensitive they are. Which kind of lends itself to like a couple of different models, and I've built a bunch of different models kind of in my working career. And so, a lot of people build market size models, financial models, value driver models. So if you're in consulting, that's very common to build a value driver model, and they differ from kind of financial models in that they're estimating something. So a model I built when I was a consultant was looking at like how many people eat ice cream in Australia, and then like the segments of the customer base who eat ice cream, and then like based on specific trends, like the premiumization of ice cream. I don't know if people like ice cream, but like there is a premiumization of ice cream that's going on right now in the market where people are buying, more Messina, and then Messina's entering Woolworths, so you can buy like takeaway at Messina. But modeling out like as that trend continues, how big does the market grow and what does that look like? If you're, working in a product or working in a startup or even working in VC, you might do a lot of cohort analysis, which is looking at, retention based on specific cohorts of users or customers within your company or product you manage. And then obviously if you're in finance, in VC, in investing, you might be building one of many different kind of valuation models. Anyone have any kind of questions? It's kind of a very quick overview about, Excel and how you can use it. I think I'm going to kind of spend the next maybe like 20 to 25 minutes walking through kind of the steps I take when I build out specifically a financial model, but this really applies to kind of any of these 5 models here or any model generally in Excel. I think for me, the first step really, I think of it kind of in a loose 6-step structure. But really the first 5 steps, I don't ever touch my computer. I spend a lot of time thinking about what I'm going to do rather than doing. And so really what I want to get out is that when you use Excel, you're really just trying to solve a problem. And part of that problem is done through Excel, and it'll spit out calculations so that you don't have to do that. And so the first step for me when I'm trying to build out a financial model or any sort of model is like, what am I trying to solve? What specifically is the problem here? Whether it's like, am I trying to estimate a market size? Am I trying to build out a big financial forecast? Am I trying to understand, how many people eat ice cream? What's the size of the ice cream market in Australia? And so once I've determined that, I then backward solve for what are the outputs. So if we've got this problem, what do I need to show that I've solved the problem? And obviously that comes in many different forms, but more often than not, it's some sort of chart. So if you're looking at, revenue growth, that's going to be, potential charts of revenue going up and to the right, increasing every year. Maybe it's like a cost reduction to show that these are specifically the cost levers you can pull and what that looks like when you reduce costs. Maybe it's like a nice little waterfall chart. Maybe it's a table, but helping you determine what the outputs are means that you can then narrow what you need to build in Excel. So once you've got the problem and then the output, so the result that you're trying to show, I guess the next step is to then build an approach, which I'll walk through in a sec, but it's basically like, what are the kind of calculations I need to get to the end result? And so if I keep talking about this ice cream example, it's like, if I want to know how many people eat ice cream in Australia, people buy ice cream in many different ways. You can go to Woolies, to a grocery store to buy ice cream. You can go to a boutique ice cream store like Messina or Riverino or Mapo or wherever you are to buy ice cream. You can buy ice cream from like the movies. And so you need to understand, is that important in terms of my calculations to determine how big the market size is for ice cream in Australia. Once I've kind of built out an approach, I'll just test that approach, whether it's someone I'm working with or someone else. So like, does this make sense? Like if I'm trying to calculate the amount of ice cream in Australia, if I'm trying to calculate, revenue growth for this company, does this broadly make sense? And then if it does make sense, I'll quickly just check, like, is there data available to support that? And so, using the thread of ice cream sales again, like there's not that many ice cream sales in Australia, but you can use other data as a proxy, like, population, density. You can start to look at, where the location of ice cream stores are around the country is. And then once I've kind of gone through these 5 steps to check, do I have a problem? Do I have outputs? I then start to kind of build out something in Excel. Is there any questions on that? I know it's kind of a bit kind of nebulous at the moment, as these are just images on the slide, but I'll kind of walk through a super high level example. No, sweet. Cool. So I'll just kind of quickly walk through an example of a super basic B2B SaaS model. It's really, really basic, and you don't necessarily need a strong kind of financial background to understand what's going on. But really, the reason why you build a financial model, 3 key things. And sometimes founders I talk to ask, like, why do I need a financial model? Or why does my financial model have to be structured in a particular way? But ultimately, a lot of investors are looking at 3 things. The first is like, do you understand your business quantitatively? As in, like, do you understand how the different levers in a business are structured? Do you understand what drives growth in your business? And then lastly, do you have like a realistic expectation of how your business is going to grow? And if you're going to shoot the lights out, what does that business look like? If you're not going to shoot the lights out, what does your business look like? And so, when you build a financial model, it needs to be a representation of your business. So it needs to be very representative of how you grow. It needs to be quite detailed in terms of what those levers are. And then it needs to be dynamic. It needs to be flexible for someone to come in and take that model and play around with assumptions. And so when I talk about, drawing it out or trying to build out an approach, this is really what it looks like for B2B SaaS. There's quite a lot here going on, so maybe I'll zoom out a bit. But if you read it left to right and then right to left, ultimately the output I want to show is revenue. And so this is revenue here. And then when I go back to keep kind of moving on right, my approach to understanding revenue is really 3 things. It's like, how much revenue am I getting from new customers? How much revenue am I getting from existing customers? And then how much revenue am I losing from customers who churn? And then you can start to click on each of these kind of key buckets of revenue to understand how you get to that. So your approach kind of keeps broadening. Your revenue from new customers is the number of new customers you sign in a particular month or year, multiplied by the average contract value of each customer. So if you've got a new customer every month and they're bringing in $100, then your revenue from new customers per month is $100. And then similarly, you might just stop there, but an investor might ask, like, how do you get new customers? And so you can kind of keep pulling that thread, which is new customers, the number of leads that you generate, or your sales team generate, times your conversion rate. And then you can keep pulling that thread once again, which is like the number of leads is really a combination of inbound and outbound. And you can keep building that out as, the leads are a funnel, but I've just stopped there. And so this is really one of the first steps that I take out when, speaking to founders or asking them, how does your business work? How do you grow? What are the levers required to grow? Because any of these things here on the right influence the ultimate outcome on the left, which is revenue. Does that make sense, or is that kind of too much? Please stop me, ask any questions. Yeah, sweet. So this is kind of what the approach looks like from a kind of theoretical point of view. from a, like an Excel point of view, it really manifests itself in a structured Excel workbook where I go inputs, assumptions, calculations, and then outputs. And, once again, I'll kind of walk through this in Excel, but at a high level, the way I structure my workbooks is very similar. So I'll have a set of inputs and I put them all on one sheet. And this is, really best practice for kind of any Excel modeling, is just to keep all your inputs generally separate from your outputs, or flag what's input or historical data. I'll have then a set of assumptions, which will then influence calculations. And then once I've done my calculations, I'll compile everything into an outputs tab. Any questions? No, cool. I feel like we're moving very quickly. All right, let me change screens. Stop sharing. I'll do this. All right. All right, can everyone see my screen? Sweet. So I've just put out a super simple P&L here that goes from revenue, COGS, so cost of goods, gross profit, gross margin, operating expenses, and then EBITDA. So super high level P&L. This is what you'd probably expect to put into a table as part of your pitch deck, or as part of a presentation as the outputs of the model, or maybe, if you're trying to build out financial models for investing and you've built a company out, this is generally what the end output looks like. So if you've ever looked at like an annual report, you'll see a table that's very similar to this that kind of walks through a P&L. If you've looked at investor presentations, if you looked at pitch decks, they often have a financial table like this that kind of walks through this entire structure, revenue all the way down to EBITDA.
Albert, sorry, just got a question come through from Antora. Antora's curious to know if you can explain what EBITDA stands for, maybe what it means.
Yeah, good question. Just as a quick aside as well, is there anyone who's not super familiar with a P&L, and I can kind of just quickly go through it? No, cool. So EBITDA stands for earnings before interest, tax, depreciation, amortization. It's a measure of profitability that's used in a lot of financial reporting to understand what is kind of the profitability of a company, taking out these key things: interests, tax, depreciation, and amortization. Now, I won't go into like deep accounting and things like that, but the reason why they use EBITDA is because it lets you directly compare between different businesses and different business models, because different businesses have different business models, have accounting practices and rules that influence profitability from an accounting perspective. So it's really just a measure of profitability, and it's often used because it can be compared across other companies and industries. Any other questions before I kind of move on? Sweet. So in that driver tree I was showing before, and maybe I'll take, I can't. One of the first things on the far right-hand side was looking at your customer funnel. And so how you go from your lead generation all the way down to your customer acquisition. So here I've built out 3 tabs: revenue, cost, customer acquisition. And so if I click on the customer acquisition tab, I've just built out a super simple funnel here that goes from salespeople to leads to conversions to new customers. And so here I've got a funnel that goes and lets me model out, if I've got a particular number of salespeople, they'll generate a particular number of leads. And for each lead, those leads are going to convert, which means I'll have X number of new customers each month. So if I walk through that very quickly, I've got 1 salesperson here in this month. they'll generate 2 leads. I'm converting leads at a 50% conversion rate, which means for this particular month, I've signed 1 new customer. So it's pretty simple. I think here I've got these assumptions that let me play around with my customer growth. So I know that if I hire another person, that means my sales funnel is going to increase because they're, bringing in more leads, and those leads are converting into new customers. Similarly, if I work my salespeople a bit harder and I make them generate more leads, maybe then I'm getting more customers. So here, instead of 2 leads per month, my sales team is generating 4 leads per month each. So that's 8 leads. And if I've got a conversion rate of 50%, that then means I'm getting 4 customers. Does that broadly kind of make sense? So this is the kind of customer acquisition part of the funnel. So in a lot of financial models, people will build something to assume growth. So they'll say they're going to grow their customer base by 10%, or they'll grow revenue by 10%. But in this model, I haven't assumed kind of growth just comes free. I've assumed that this comes based on sales and how that sales funnel works. So now I've got my new customer breakdown, and I can start to see each month that's growing pretty nicely to the end of the year. So last month, on May 22, I've got 48 customers at the end of that period. So I've just taken that and forecast my customer growth rate. And the key here thing is I can flex these assumptions. So if I say I want to go really hard on sales, I can say hire 20 people, and they're getting 4 leads, and they're converting still at the same rate at 50%, then I can see that my customer growth really starts to skyrocket up to 480. I've then taken kind of these customer growth numbers and put them here to start forecasting revenue. So if we go back to that driver tree, once you've got the customer numbers, the next step was then to look at like how much each customer is bringing in, or what their contract value is, because that helps you forecast revenue. So here I've got the number of customers, super basic, in each month. I've got a revenue per customer. So for each customer, they're going to bring in X amount of dollars. And then I've just got a high level churn number of 5%. And so here I can start to see, I've got 40 customers. They're each bringing in $500. I'm churning about 5% of them each month. And so my revenue is $1,000 per month, or in this month. I can, start to say like, oh, what if we increase our price to, $700? That's probably going to increase churn a bit. And so I can start to play around with what these levers are and how they impact my business. Any questions on that? So from a mechanics point of view, I've really just taken the customer modeling I did on the previous page, the customer acquisition page, forecast the customer growth based on, sales, leads, and conversions. So what that funnel looks like. And then I've taken those customer numbers, brought them into a revenue tab, and then now I've started to forecast for each customer, how much revenue are they going to bring in. And this is, very basic, but you can start to segment this. If you've got enterprise customers, maybe they're bringing in more money. If you've got, SMB customers, maybe they're bringing in less money per month. And so you basically replicate this for enterprise, and, maybe they're doing $10,000 a month, and then you can replicate it as well for SMB. And maybe they're doing $500 a month. So then you can start to get more granular with your financial model, in the same way that you can get really granular with any kind of detailing as you start to segment out. A customer base looks like this. It's split into enterprise, SMB, and medium. And then you can segment that further if you want to get more detailed in your modeling. Maybe we split out enterprise by the US, EMEA, and APAC. And then you can start to split out those geographies again as well by like Australia. So then you can really start to model out very specifically what's going to drive growth. But for this example, I've just kept it super high level. Any questions on that? Sweet. And then, I mean, this is probably really is more for a cap raise than anything else. But when forecasting costs, I often do it super high level. So I've forecast cost of goods. And so I've just done this based on number of customers. So here I've just got AWS costs and then implementation cost. So for each customer, it's costing $3 per month for AWS and then $5 per month for implementation or customer support services to get me my COGS. And then just to keep it really simple, forecasting revenue or forecasting operating costs, so OPEX, as a percentage of revenue. So here I've got, the kind of three broad buckets of operating costs: sales and marketing, research and development, and admin costs. And I've just taken them as a percentage of revenue. So sales and marketing is 20%, research and development is 5%, admin is 3%. Then I can kind of flex this. So say we blow sales and marketing out to 100%. Now that's increasing my OPEX. But if I say, let's run something much leaner and run this at 10%, then I can start to see how that impacts my cost line as well. Any questions?
Yeah, I had a question. So with your customer acquisition, for example, you had your salespeople and the leads and stuff like that. For example, like the more salespeople you get, the less like number of leads each sales rep could realistically get. So essentially there'd be some sort of tapering. Is there any effective way to sort of like model that out? Because obviously like it doesn't just like consistently just grow, it obviously like tapers out at some point. Yeah, like does Excel like allow for that efficiently?
Yeah, for sure. It's a great question. So you can do it. There's not a lot of elegant solutions in terms of tapering in Excel. Here right now I've split out the assumptions just by financial year. So this just says FY22, but say if I just did this and I extend this out, FY23. Sorry, bear with me, team, while I just do this. You can kind of taper it out if you just add an assumption for it. So here I've got, say, 20, and then maybe they're doing 2 leads, and then now let's say they're still converting at 50%. So here, like it's kind of jagged a tape. It's very like you go from 4 to 2, and then there's kind of things you can build into your formula so that this decreases over time. So the answer is yes, you can. But in terms of a financial model, there's no like smoothing out that you can do on the fly. You probably have to start building in particular things in an Excel formula, which
gotcha.
It may or may not be representative.
Yeah, gotcha. Cool.
Any other questions? I think that is a good question though, because as you're building out a model like this, people are going to ask that. It's like, obviously, as you scale up, conversions are going to change. Like it's going to be quite hard to sustain a 50% conversion rate in perpetuity or for multiple years. It's going to be hard to get, 4 leads per month every month as you increase your sales team, because, there's more competition for leads for the same customer base. And then, if you're playing in a large market, that might be true, but if you're playing in a small market, you might be exhausting all your leads. So those are the questions that someone's going to ask as you build out a model. And so having this kind of flexibility where you can play around means that your model isn't static, and so that you can run, different scenarios or test different assumptions to say like, actually, even if we do still, convert at a lower rate, we'll increase the prices to combat that, or we'll do this, or we'll do that. Any other questions? No, sweet. I think I was at costs. Yeah, generally forecasting costs, it's actually quite difficult to forecast costs. So, and depending on what you're building a model for, it can be a bit overkill, to be honest, to forecast costs at a really granular level. Sean might be able to talk to this, but from the investors that you know we talk to, they're really looking at the growth and particular customer acquisition part of the business to understand what the business is, how the business works, and how you create value. The revenue side, particularly on a lot of B2B SaaS businesses, is where a lot of investors are focused on around pricing, customer acquisition, and costs haven't necessarily been a major part of forecasting in great detail. Now that's obviously changing, but just to keep things simple, I've just forecast costs here as a percentage of revenue. So sales and marketing, research dev, and admin here are just a percentage of overall revenue. So similar to your customer acquisition assumptions, you can kind of flex these depending on how much you think you're going to invest, etc. Any questions on that? Cool. I think it's worth noting that I've kind of constructed this kind of almost backwards in a way, where I've assumed customer acquisition, which is then informed revenue, and then that revenue then informs costs. Some people like to build their models the other way around, which is they forecast their sales and marketing spend, and then like staffing. So we're going to hire X amount of sales people, we're going to hire X amount of marketing people, or we're going to invest this much in sales and marketing channels, and then assume based on a particular spend, this is the customer conversion rate. And then based on the conversion rate, this is what their revenue is. I think there's no kind of real or true way to do it, as long as when you sense check your customer acquisition and your sales, it matches up. So obviously it's very difficult to say, we're going to shoot the lights out from a customer perspective. And then when you try to marry that up with your sales and marketing side or your cost side, it doesn't work out, because then once you start to model things like customer acquisition costs, it shows that you might have underbaked or overbaked, either your customer growth or your costs. So there's no kind of true way to model out whether you start at sales and marketing and then go to customer acquisition and then revenue, or whether you go the other way and go sales and marketing, you go the other way, customer acquisition, revenue, then sales and marketing, as long as they narratively fit together. Any questions? Cool. And then this kind of leads me back to my first tab, which is just a very basic P&L, which takes inputs from the revenue tab, from the cost tab, and then just spits out a pro forma P&L that you could copy and paste into a presentation, or that you can take someone through your model without having to click sheet by sheet. Just having a summary page like this just means that you can focus attention, discussion onto one page without having to take someone who might not understand the model and all the calculations through page by page. And then that is it. Any questions? So I'm going to quickly just jump back to the presentation now. I'll do this.
Just a quick one while you're doing that, Albert. It's good to see how I mate.
How you going?
Yeah, mate, I'm great. And this is a fantastic presentation. For those who've never seen this stuff before, this is really like the important stuff. I was just going to quickly drill down, and obviously I know you whipped that one together, but in your sort of day-to-day wearing your hat, doing a bunch of deals, looking at lots of investments, how far into the future do you typically think about baking that model? And apologies if I missed it, but if we think about a pre-seed, I think 12 months is probably good, but then how do you see that sort of tracking, and does that differ between B2B or B2C businesses?
Yeah, it's a really good question. So it all depends on the use case. So if it's a model for a capital raise, the way I look at it is almost always 2 or 3 years. I think 5 years is probably overkill, because in 5 years' time, the business changes radically, the forecast becomes less accurate, and then you're forecasting something with incredible precision, but with very poor accuracy. And so I think personally, like a 2 to 3 year model is sufficient because it shows you like these are the milestones we're going to hit from a metrics perspective. If we get this cash to the door, these are the highs that we're going to make, and this is what we think the business could look like based on these estimates. 5 years,
Awesome.
you give the sense of false precision when you're doing like a 5 year model, and everyone underbakes their costs, which means your like cash just looks incredible after a 5 year model.
Awesome. Love it, mate. Thanks.
Cool. I think just lastly, can you see my screen again? Sweet. I've got the kind of this rule of thumb here that I personally never write a formula that's longer than my finger. I think like Excel models can be super complicated, and formulas can be really, really complicated. And if you ever received a model from somebody else, and you're trying to diagnose how a formula works or what the formula does, and it's got, you know, a bunch of kind of random things in it, it's really difficult to diagnose. And so based on that, kind of my rule of thumb is like any model I build, whether it's an Excel or, you know, anything else, someone else is going to look at that, whether it's on the founder, another investor, someone I work with, etc. And so writing a formula that's quite short means I have to spend more time structuring out my Excel workbook, but it ultimately means it makes it easier for someone else to digest. And then the other thing is like, these are 2 formulas I use all the time, index match and sum ifs. If you don't know how to use them, it's probably worth kind of looking them up. They're incredibly useful. They're not longer than a finger, which is great. And it just kind of streamlines your own workflow. I think the first point here is really, if you're going to take anything away from this presentation, is like structure is the most important thing in a workbook. And when I talk about structure, I mean like setting out an Excel model so that it's structured in inputs, assumptions, calculations, and then outputs. It's very clear that you can see what's an input that someone can play around with, what are assumptions that you know, you've put into the model, what's a calculation that people shouldn't touch because they're critical to these outputs. Like if you can really nail these things, and the way I structure mine is, depending on the model, I will literally have a tab called inputs or data, and I'll literally have a tab called assumptions, and then a tab called calculations that I'll lock or I'll tell people not to touch, and then a page just for outputs that I can easily copy and paste into other, you know, presentations, other tables and things like that. That just helps me keep the structure, but also means people know what they can and can't play with. Like people can't play with calculations because they'll break the model. People can't play with historical data because that's real data. And then lastly, a couple of super useful resources. Here's the FAST standard. So this is a standard that's kind of been set by a bunch of financial modelers that just goes through like rules for structuring a workbook, as well as how to design a model. Like would highly recommend. Now, I think I've posted this a couple of times in the Work chat or Slack group now, but I'll share it in the investing channel as well. It's kind of a guidebook for how to structure out in a very granular detail what an Excel model looks like, not just a financial model, but a lot of other models. This website called finbox.io, which I use a lot kind of in my personal life. For $1, you can buy a model that someone else has built in a lot of different cases. So like I use it for investing. Someone will build like a very detailed financial model for, say, like Twitter. It means instead of having to build my own model from scratch, I actually can just go download someone else's financial model for $1 and then play around with their assumptions. And then if you want to learn how to build, you know, really good financial models, I'd recommend a course called A Simple Model. It's only a couple dollars a month. It's much cheaper than some of the other courses like Breaking into Wall Street and things like that. But it does kind of step you through building very basic financial models to building like private equity style LBO models if you're looking to do or break into private equity. It'll teach you how to build market size models and things like that. It's only a couple dollars a month, so highly recommended, and it's cheaper than other financial model courses that you can find online. And I think that's it. Any questions?
Awesome. Albert, thanks so much for that. That was a super fascinating, practical, and incredibly useful presentation. And I'm sure lots of folks in the early work community will use this resource for many months and practical exercises and capital raisings to come, hopefully. So we'll be putting that on the early work resource hub, and we'll share that with sort of investing community for those that couldn't join us. But yeah, I think these are the type of things that they don't teach you in a university, but you know, it's often some of the more practical things. Gianna, do you have a question?
Yes, I had a question. Thanks, thanks. Took me a while to type it, but I'm sorry, I'm not very familiar with the financial models, but I'm curious how you use Excel to model your personal finances.
Yeah, good question. This is probably where I will probably plug Google Sheets because it is better than Excel for this particular purpose. And so I've got like an investment tracker that tracks my personal wealth across my share portfolio, crypto, like private market investments that I've made, and then cash. So I generally update it once, you know, every 2 or 3 weeks. But because Google Sheets obviously is in the cloud, you can do live updates of share prices. And so I won't share mine here, but maybe I can strip it away. You can track particular metrics for investments. So I've got like metrics that you can pull automatically from G Sheets. And if you go to G Sheets and type in like investment metric formulas, you can quickly see how they structure it out. But you basically type the ticker, and then you can choose like revenue, you can choose like costs, you can choose like enterprise value, EBIT, cash, etc. So you can quickly track in G Sheets financial metrics for listed companies. And so I've got a like personal wealth tracker that tracks investments and cash, and then just compile it, you know, once a month or so. It doesn't track my spending though. I just put my cash. I don't want to look at that. I think just looking at the comments here, Sean's got one about headcount. Yeah, so normally when we build out like a detailed financial model or a cap raise model, we generally split OPEX and headcount. So we'll list out the salary costs for employees, and then we'll have the OPEX on top of that, just because then it lets us really granularly see what the hiring plan is for a particular company. So if you're looking to raise, you know, like $1 million round, how that $1 million actually gets allocated across particular employees and individuals, and then what's just general OPEX. So if you're building a model, especially for a cap raise, but you know, more broadly as a financial model, it's good to split out what salary costs and like associated on costs like superannuation, pensions, recruitment, etc., versus what's generally OPEX like rent, you know, entertainment, travel, training, etc. Cool. I think that's it. Any other questions?
Awesome. Maybe Albert, would be awesome if you could maybe share the Excel template for that like B2B SaaS one you built out. You know, you can put it on a Google Sheet for the, you know, maybe if it's more accessible to people that maybe don't have Excel. But yeah, other than that, maybe we'll wrap it up here, but we'll share the recording for those that have made it, because we had a lot of interest in the sign-ups. I think the Zoom fatigue is real these days. But I appreciate everyone on the call here for joining us, and big claps or Zoom reacts for Albert for taking the time.
TY, thank you everyone for jumping on at 8 p.m. on a Monday night.
Awesome. Hope everyone has a lovely evening and rest of the week.